Welcome to the Deep Dive.
Good to be here.
Today, we're digging into the recent earnings call from Dynatrace. We're looking at their fourth quarter and the full fiscal year 2025 results.
That's right. The goal is really to get past the surface level numbers and understand what management's saying about, the business direction, the strategy.
Yeah, what's really driving things. So let's kick off with the headline numbers, the snapshot for fiscal 25.
Okay, so full year, they brought in $1.62 billion in subscription revenue. That's up 20% year over year.
Solid growth. And total revenue.
Just a touch higher, $1.7 billion, also growing 20%. So pretty consistent there.
And drilling down into Q4 specifically.
Q4 subscription revenue was $424 million, again, up 20% versus last year's Q4.
Okay.
And Q4 total revenue, $445 million. That was up 19%.
And ARR, annual recurring revenue, always this big one.
Yeah, definitely. They finished the year at $1.73 billion in ARR. That represents 17% growth year over year. And interestingly, they noted that was slightly above the high end of their own guidance.
So they beat their own expectations there. And it sounds like across the board in Q4.
Pretty much. Yeah, they highlighted exceeding the high end of guidance, not just on ARR, but across key top-line growth metrics and profitability for the quarter.
And profitability for the full year looked good too, right? Margins improved.
We did. Non-GAAP operating margin expanded by over 100 basis points. And pre-tax free cash flow margin was up roughly 250 basis points for the full year.
So good execution alongside that growth then.
Exactly. It paints a picture of strong execution and a really solid finish to their fiscal year.
Okay, so moving beyond just the financials, what about key milestones? Did they call out any big achievements for FY25?
They did. Several significant ones, actually. Showcasing scale, really. Surpassing $1.7 billion in total ARR was one.
Right.
Hitting $1 billion in ARR just from their DPS model, the Dynatrace Platform Subscription.
That's a big chunk.
It is. Growing their customer base past 4,000 and also reaching over 5,000 employees globally.
Right.
So yeah, significant scale milestones.
Okay. Let's shift to the market context. How did management describe the environment? Because, we keep hearing about economic uncertainty.
Right. They acknowledge that uncertainty for sure. But their take is that the actual observability market, it remains pretty strong.
Okay.
They emphasize that spending here is still a priority for companies.
Why is that exactly? What's the reasoning?
Well, it boils down to this. Software has to work perfectly, ideally. Businesses depend on it. So observability isn't really a nice to have anymore. It helps boost productivity, deliver better user experiences, and crucially, it helps cut costs by finding and fixing problems faster.
So it's seen as foundational, not discretionary spending.
That's the argument, yeah. And they also pointed to the cloud growth tailwind, still very significant.
The hyperscalers, right. AWS, Azure, Google Cloud.
Exactly. Generating nearly $250 billion in annualized revenue combined and still growing in the mid-20% range. And that acceleration in cloud adoption, plus all the AI native stuff that's emerging, well, that directly fuels the need for advanced AI-powered observability. Stuff that can handle massive scale.
So they expect to get deeper into those hyperscaler workloads.
Yeah, they see that as where the majority of the market opportunity really lies now.
Okay, makes sense. So let's unpack their own growth drivers.
All right.
What did they identify as the key engines for Dynatrace moving forward? What's number one?
First up is their ongoing investment and evolution in their go-to-market strategy.
Okay, what does that involve?
It's things like refining customer segmentation, better partner enablement, and really broadening the sales conversation. Moving beyond just traditional APM, application performance monitoring, to cover that whole end-to-end observability picture, and also helping customers with cloud modernization.
And are they seeing traction there? Any proof points?
They seem to think so. They mentioned expecting sales productivity gains in FY26. Pipeline growth looks strong, 45% growth in strategic accounts specifically.
That's significant.
It is. And they noted over 80% of their ACV, annual contract value, in Q4 was partner influenced. Plus, over half of their big anchor deals in Q4 were focused on driving that broader end-to-end observability adoption.
So the strategy seems to be landing.
And closing 15 deals in Q4 with over $1 million in incremental ACV each.
Yeah.
That's pretty concrete evidence, right?
Yeah, hard to argue with that. Okay, driver number 2. You mentioned it earlier, the DPS licensing model, Dynatrace Platform Subscription.
Yes. This is really picking up steam. They finished Q4 with over 40% of their customer base using it. And that accounts for more than 60% of their total ARR now.
Wow, that's a fast shift. And the idea is giving access to everything encourages more usage.
That's the core thesis. And the data they shared backs it up. DPS customers use, on average, 12 different capabilities on the platform. Compare that to just 5 for customers on the older SKU-based licenses.
Big difference.
Huge. And maybe even more importantly, their consumption growth rate is twice as high, 2 times higher.
So they're using more and using it faster.
Exactly. And management said this increased consumption shows up over time. Either customers expand their contracts early, or they start using ODC on-demand consumption, paying for usage above their committed level.
Okay, got it. Driver number 3, log management. They positioned this as ripe for disruption.
Yeah, that was the term, because a lot of companies are apparently stuck with expensive legacy log tools that work in silos.
Yeah.
Separate from everything else.
Right.
Dynatrace's pitch is different. Integrated. Logs, traces, metrics, even security data, all on one platform, powered by their AI.
And how's adoption looking there?
Accelerating. They said a third of their customers are now using Dynatrace for logs. That's up 18% just in Q3. And almost half, nearly 50% of the new customers they signed in Q4 deployed logs right from the start.
Okay, that's strong.
Yeah, they called it out as their fastest growing product category. Suggests that integrated approach is really hitting a nerve.
All right. And the 4th driver, this one sounds more future focused, the AI revolution.
Definitely forward-looking. Management talked about this shift towards agentic AI systems.
Agentic AI, what does that mean?
Think systems that don't just report problems, but can actually plan, make decisions, and act autonomously to fix them.
Ah, okay. Automated action.
Exactly. And they believe Dynatrace is perfectly positioned for this. Their purpose-built AI, Datus, and their data lakehouse, Grail. They see this as a massive future opportunity. They also pointed to being recognized as a leader in AI ops already.
So what does that agentic AI vision look like for a customer, practically speaking?
Well, imagine a system that detects an issue, figures out the root cause, understands the business impact, maybe suggests the best fix, and could potentially even automatically trigger the remediation actions.
Without a human needing to step in?
Potentially, yes, for certain things.
Yeah.
Because achieving that requires capabilities like a common data lakehouse, like Grail, to unify all the data, real-time action capabilities, AI that finds causation, not just correlation, and the ability to mix AI techniques and delegate tasks. They feel Grail and Davis give them a unique edge here.
Interesting. They also touched on something called business observability. That's more than just technical stuff, right?
Absolutely. It's about linking IT performance directly to business results. Customers are using Dynatrace more and more to see how, say, application performance impacts sales conversions or customer churn or transaction success rates.
Real business metrics.
Exactly. They gave an example of a cruise ship operator using Dynatrace to track key passenger experiences on board, then drilling right down into the underlying tech when something goes wrong. It shows that shift, it's not just about IT health anymore. It's about understanding the actual business performance.
And they had some big Q4 wins that showcase these trends.
Yeah, they mentioned an airline, a large Canadian financial services firm, a major software company. Key drivers for those deals were things like consolidating lots of different tools, cutting costs, adopting new things like logs, and just ensuring critical applications perform well.
Okay. And there was a leadership change mentioned too.
Yes, a quick note. Welcome Steve McMahon as the new Chief Customer Officer. Highlighted his experience in observability and security.
Got it. Okay, let's pivot to the outlook. The guidings for fiscal year 26. Management sounded a bit cautious.
They did adopt, what they call the mindful stance, citing the, fluid geopolitical and macro landscape, standard stuff these days, but they built it into the forecast.
So their guidance assumes some continued caution from customers.
Yes. Specifically, assumptions around potentially tighter budget scrutiny, maybe longer sales cycles, particularly for those larger, more complex deals.
Right. So what did that translate into for the actual FY26 numbers, full year forecast?
Okay, for ARR, they guided $1.975 billion to $1.99 billion. That's 14% growth.
Okay.
Total revenue, $1.95 billion to $1.965 billion. That applies 15% growth.
Right.
And subscription revenue, $1.865 billion to $1.88 billion, also 15% growth.
And you mentioned ODC earlier, the on-demand consumption. Was that factored in?
It was. They specifically included a $30 million assumption for ODC revenue within that subscription number.
Right.
And they explicitly called that out as being conservative.
Good to know. Profitability.
Non-GAAP operating margin target is 29%. Non-GAAP EPS, earnings per share, between $1.56 and $1.59.
And cash flow?
Free cash flow guided between $505 million and $515 million. That's projected to be 26% of revenue, which is about a 100 basis point improvement year over year. Pre-tax free cash flow margin expected at 32%.
Okay. And for Q1 specifically, any guidance there?
Yep, Q1 FY26. Total revenue and subscription revenue both guided to grow 16-17%.
Yeah.
Non-GAAP operating margin 28.5%, and EPS 0.37 cents, 38.8 cents.
All right. Now, the Q&A session on these calls, that's often where you get some extra color. What were the key topics that came up?
Yeah, Q&A was interesting. Logs definitely got a lot of airtime.
Expectedly, given the growth.
Right. Management said they're very pleased. Confirmed again, fastest growing category, over a third of customers using it now. They expect log consumption growth to be well over 100% in FY26.
Wow, over 100% growth.
Yeah. And they said they're highly confident they'll beat their $100 million consumption goal for logs this fiscal year. They also tied some of that recent acceleration to a big upgrade wave back in October.
Interesting. What else? Go-to-market evolution.
Yep. They talk more about that. Express satisfaction with how they're focusing on customers with a higher propensity to expand. Highlighted channel success again, over 3/4 of business influenced by partners now.
Okay.
And the sales plays around tool consolidation seem to be working really well. Big news for FY26 is these new dedicated strike teams.
Strike team.
Yeah, focus specifically on driving adoption and consumption for logs, AppSec, that's application security, and DEM, digital experience monitoring.
So dedicated resources pushing those specific areas. Makes sense. What about strategic accounts? That 45% pipeline growth is eye-catching.
It is, but they balance that by saying, while demand is resilient in those big accounts, the general macro caution might be stretching out sales cycles for the very largest deals, especially those involving big consolidation efforts.
So pipeline is good fuel, but conversion might take a bit longer.
Sort of. They framed pipeline as fuel, absolutely. But they also emphasized that consumption is becoming increasingly core to future growth, especially with, over 60% of ARR now on that DPS model.
Got it. Did the security opportunity come up much? AppSec?
It did. They see unlocking the full potential there as needing two things. One, expanding the product portfolio. They mentioned RBA, risk-based alerting, having traction, and future plans for things like CDR, Cloud SIM, Kubernetes security, CSPM.
Lots of acronyms there.
Yes. Cloud attack detection and response, cloud security info management, cloud security posture management, basically broadening the security offering.
And the second thing needed?
Dedicated go-to-market, which ties back to that new AppSec strike team, product plus focused selling motion.
Okay. You mentioned ODC, on-demand consumption, earlier. Sounds like investors had questions about that too.
Lots of questions, yeah. So newer, growing. They explained how they built that $30 million guidance number using cohort analysis. Acknowledged it's conservative because, well, it's uncommitted revenue, like ARR, and they just don't have years of history on it yet.
Right.
They also clarified ODC is kind of a separate lever for subscription revenue growth. It doesn't get counted in metrics like NRR, net retention rate, or even ARR itself.
Oh, interesting. So it's growth outside of the traditional measures.
Exactly. They even said if ODC usage from Q4 had been included in the NRR calculation, NRR would have actually ticked up modestly.
Huh.
And they also see ODC as potentially helpful in a tight economy. Lets customers use more without having to commit to a bigger contract upfront. Flexibility.
That creates an interesting tension, though, right, between ODC growth and overall predictability.
It does. And management addressed that head on. They highlighted a shift in incentives. Those customer success teams, the new strike teams, their performance metrics are going to be exclusively based on driving consumption and adoption.
So align the incentives.
Precisely. The goal is clear. Turn that underlying consumption into either ODC revenue or, ideally, convert it into new committed ARR over time. They basically said, look, we're deliberately shifting towards a more consumption-driven story.
Which explains the NRR discussion too, then.
Exactly. The Q4 NRR was 110%. Because ODC is uncommitted, it's not in that calculation. But that same ODC usage does contribute to overall subscription revenue growth when it happens. So the metrics diverge a bit.
Okay, understood. What about agentic AI? Any more on that in the Q&A?
Yeah, they confirm they're moving aggressively on that front.
Right.
Said it's driven by customers wanting more automation, more actionable insights. Not just data, but answers. All
right.
They reiterated their multi-layered AI approach, combining their deterministic AI, Davis, with newer generative techniques, and how Grail provides that unique data foundation. They really think this could fundamentally change observability workflows. Much more automation.
Okay. And finally, anything more on DPS adoption or platform expansion?
Just reinforcing the points, mostly. Strong DPS penetration, over 40% customers, 60% ARR, aiming for 75-85% long-term. Clearly linking DPS to customers using way more capabilities, that 12 versus 5 number again.
Right.
Strategy is to keep expanding the platform, both deeper in existing areas and broader, like logs, AppSec, DEM, and now database observability through the Metis acquisition they recently did.
So adding more capabilities to drive consumption.
Exactly. And they stress there's still significant opportunity within the existing base, especially getting customers using logs to go deeper with log analytics, plus strong confidence in hyperscaler partnerships, like AWS co-selling, to accelerate channel growth in FY26.
Okay, quite a comprehensive picture. Let's switch gears completely now.
All right.
This has been purely about dissecting the earnings call, summarizing the information presented. So just to be crystal clear, this is not financial advice.
Definitely not. Purely informational.
But purely as an intellectual exercise. If we put on our, let's say, slightly outrageous speculation hats, what kind of wild yet plausible trade ideas could someone hypothetically cook up based only on the specific things discussed on this call?
Okay, speculation hat on. Remember, these are just connecting dots from the transcript into what-if scenarios, not recommendations.
Understood. Idea number one.
Let's call it the logs acceleration surprise pitch. Go long Dynatrace. The bet is that the market is seriously underestimating the momentum in their logs business, and it could drive upside surprises way faster than the overall guidance implies.
Okay, justification. Where does that come from on the call?
Straight from management's mouth. Logs is fastest growing category, used by over a third of customers already, nearly half of new logos deploying it first. They guided well over 100% consumption growth for logs in FY26 and expect to beat the $100 million consumption goal this year.
Plausibility seems high then, based directly on their commentary.
The plausibility of the data points is high, yes.
Right, so what makes it wild?
The wild part is assuming this logs growth keeps ripping at that pace and that it materially drags the entire company's results significantly above the overall 13-14% ARR guidance faster than anyone expects. Betting the log's tail wags the whole dog much harder and sooner.
Got it. Okay, wild but plausible idea number two.
Let's call this one the DPS consumption conversion arbitrage pitch. Go long Dynatrace again, but this time the angle is exploiting the lag between that rapidly accelerating consumption happening into the DPS model and when it actually shows up as reported revenue or committed ARR.
Explain the justification from the call.
Okay, over 40% customers, over 60% ARR, now on DPS. Fact. These customers consume way more capabilities, 12 versus 5. Fact. Their consumption grows twice as fast. Now add the new ingredient. Management is directly incentivizing teams exclusively on driving this consumption.
So you have a growing pool of usage.
Exactly. A growing pool of burning consumption that theoretically has to convert eventually, either into early renewals expansions or ODC revenue.
Plausibility seems grounded in the model mechanics and their stated priorities.
Yeah, the mechanics are there. The wildness comes from assuming the conversion rate of all that pent-up consumption into actual reported dollars, either committed ARR or ODC revenue, blowing past that conservative $30 million, accelerates dramatically faster than expected.
So betting that the dam breaks sooner and bigger than the market anticipates.
Kinda, yeah. Betting that the combination of DPS scale plus those newly incentivized strike teams overcomes macro caution and normal conversion timelines much more quickly than baked into current expectations.
Okay. Again, just hypothetical scenarios spun out of the call details. Absolutely not investment advice.
Exactly. It's just an exercise in thinking about how internal metrics and strategic shifts could, emphasis on could, lead to external financial outcomes that might surprise people. Acknowledging all the uncertainty, of course.
Right. So let's wrap up this deep dive on the Dynatrace earnings call. Key takeaway seems to be they finished FY25 strong, exceeded guidance.
Yep. Solid performance. And management seems confident about the underlying observability market strength. They see big opportunities ahead in logs, DBS adoption driving usage, and that longer-term agentic AI vision.
They're clearly investing to capture that. The go-to-market evolution, those dedicated strike teams focused on consumption, signals a real push towards a more consumption-based future.
It does, but they're also balancing that growth focus with profitability. The guidance points to continued margin expansion, even with those investments.
Okay, so one last time, this was not financial advice.
Not financial advice.
We've just walked through the key themes, the data points, the dynamics discussed by management on their call.
We hope breaking it down like this is helpful. We encourage you to think about these points, the logs growth, the DPS mechanics, the AI angle, the cautious guidance, and how they fit into your own view of Dynatrace and where the market's heading.
Yeah, absolutely. What specific detail or maybe trend from this call really stood out to you? What will you be mulling over as you watch Dynatrace navigate fiscal year 26?